Good morning, everyone. Welcome to our MNT Market Update webinar. Thank you, everyone, for joining us today. A friendly reminder that this session is being recorded, and for those unable to attend, all participants' microphones will be disabled. So if you have any questions throughout the presentation, just type them in the chat and we will address in the end of the session. In today's agenda, we're going to discuss market updates. Also, we present the harvest pool update. And in the end, we're going to discuss about DailyGrain updates. To start, let's welcome Will Reid, the manager of wheat trading. Thank you, Will.
Okay, thanks, Julie. Hi, everyone. Hope you're having a good day. We'll get into wheat. I think we're having questions at the end, so if you can hold on to them until later, that's all good. First slide, we're looking at wheat exports last year. Now, why are we looking at last year? It's just an interesting story to tell. Half our wheat went to North Asia, China, South Korea, and Japan, and essentially that's inelastic demand. The other side of the pie chart there is basically all the elastic buyers, price elastic buyers. So basically last year, obviously in WA, we had a smaller production. We had some carry-in supplies, and our wheat was relatively expensive versus other origins. And we rationed a lot of demand in the Southeast Asian and even Middle East countries. So you see Indonesia, Vietnam, which you'd expect in a normal year to feature quite heavily in WA, were really quite relatively small volumes, especially Vietnam. In the year coming forward, with a bigger crop coming, we don't have as much demand from China. As we have seen in the past 3 to 4 years, there's a big change up there with their economy and their import program. Still very much up in the air, but we do not expect anywhere near the same volumes of demand from China in this season as we've seen for the last 4 years. So really what it means is we need to compete more heavily into these elastic markets. Obviously the noodle wheat markets, Korea and Japan are still there. Their volumes are pretty steady. But all the elastic demand, Indonesia, Philippines, Malaysia, Vietnam, Thailand, and other Middle East destinations, we do need to compete more heavily into these markets in the coming year. So that will be interesting to see. We go to the next slide, Julie. This is just a look around the world. I mean, you know this story. These numbers are from the USDA. I mean, obviously the big story in world wheat this year has been the fall in production in Russia and Europe, largely. They're the headlines, but by and large, the small increases elsewhere have somewhat been ignored. So better crops in North America, South America slightly better. The USDA is quite negative on the Argentinian crop. We believe it's quite a bit bigger than that, and the market's acting like it is. China has a very good crop. I mean, that's part of the problem with their import program slowing down so much. And obviously Australia has a much better crop year on year. So the Russian story is really the big deal for the world wheat markets. So you might ask, well, why is price so low? Well, I mean, we have rallied out of the Russian harvest lows quite significantly. I mean, we got Russian wheat up to 240 with a bit of help from the government a few weeks back. It's probably pulled back a little bit now to 225 to 230 FOB US dollars. But effectively, Russia basically wants to convert their crop to cash, and they've been pushing it out very heavily. I mean, one of the more interesting stats on this slide is the world ending stocks. This is excluding China, down 8 million tonnes year on year. So the world wheat balance sheet is tightening, and it is tightening in the major exporters. There's not a lot of excess stocks anywhere really outside of the USA. So why is the wheat price so benign or come down so far? Well, A, we've come down from very high price levels in 2022, which was induced by the war. And B, everyone has been bullish wheat for the last 2 years, has just been steamrolled by the Russian export program. So they continue to push their wheat out at 5 million tonnes thereabouts a month. And as long as they can do that, there's very little incentive for the world wheat market to rally. As long as consumers around the world can get an offer of cheap Black Sea wheat, they've seen very little reason to be bullish, and that has continued. Now, that may change a little bit early next year because simply there's not enough wheat in Russia to continue this 5 million tonnes a month into the first half of next year. So that will be a little bit of a change. But in the immediate term, we've got the Australian harvest coming up, and we've also got the Argentinian, Brazilian harvest. And the South American wheat is getting absolutely blasted into Southeast Asia at the moment. That number's under ours. Now, that's not necessarily unusual because Argentinian wheat in particular always connects to Southeast Asia at harvest time. They basically price it where they need to. They undercut Aussie wheat or whatever else is going on at the time. But the Argentinian crop is probably the best one we've seen in about 3 or 4 seasons down there. So we do expect quite heavy competition to continue from Argentina, probably Jan, Feb, March. Typically, it's a relatively short program, but it's right coming out of our harvest. It is quite a drag on our values. I mean, over the past 6 months, I mean, and previous, it's been black sea wheat. There's been the main competition. The South American wheat really has taken over in the near term. So that will be interesting to see how long that tail of that export program is and just how much they want to push into Southeast Asia. We'll go to the next slide, Jules. So here's a global FOB wheat price comparison. The chart on the left is the APW FOB WA. That's the Platts price series, the independent price series. It's the APW versus the Russian wheat 12.5 in the red. So you can see we've been at quite a big premium. When Australia has a decent crop harvest and Russia's coming into the tail end of their program, typically we've seen, if you look back at 2021 harvest, 2022, a little bit murkier there because of the war and a few other things going on, but generally the price comes closer to converging. I still think the price spread needs to narrow between Australia and the rest of the world. We're simply not getting enough demand given the size of the crop that we have coming at us. Naturally, the Russian price should seasonally continue to firm. The question is how fast and how much that occurs, and how much Australia either goes down or how much can Russia come up. I mean, ultimately, the price spread is probably still too wide. Ultimately, the Argentinian price, see there, 225 FOB versus our ASW9 at 253. There's still quite a gap there. How much wheat they can push in, as I said, to Southeast Asia is going to be pretty critical as to how long or how much we need to compete in the front end. The other thing to note is there the Canadian CWRS, so that's the Canadian Western Red Spring, 13.5. So that's the high pro. That's really competing with the higher protein Australian wheats into Southeast Asia. It's a little bit of a different market, but we want to talk about protein. Where can protein go? Because potentially we're looking at a relatively low protein crop, at least in the northern parts of Western Australia. But unfortunately, the upside for H2 is probably limited by that Canadian number, because the Canadians have a pretty good crop coming, and look, historically there's a lot more export capacity in Vancouver now than there ever has been in the past, and that market just is hammering all the consumers, and basically H2 is competing with CWRS for a portion of blending protein wheat into Southeast Asia, so especially into Indonesia, and that number there really caps the upside on protein, which is a bit disappointing, but that is what it is. I mean, the global protein market is typically set by the size of spring wheat crops in Canada and North America, and the values in Canada unfortunately just don't give us much upside unless something changes there. Next slide. Harvest quality. So just a few points to note. These may be some questions you have. So getting on the front foot to answer those. AWW 1 and 2, I mean, pricing is going to evolve according to the quality we get. So I mean, it's still early in harvest. Excuse me. Sorry, we just had an alarm in the building. So pricing will evolve according to what quality we get. Obviously, the quality specs in AWW are quite wide. So I mean, it can be a low protein wheat, it can be a higher protein wheat with 5 to 10% screenings for AWW2. There's quite a wide moisture spec. So in the southern zones, we may see some high moisture wheat. So the trade really needs to see what we have till we can really hone in on an accurate price. Most of this wheat, especially the AWW1, the lower protein, is going to end up in feed markets. The AWW2 may have a different value according to if it can be blended onto milling wheat cargoes. So we just have to wait and see there. Protein spreads, I think we covered that. I mean, the cheap Canadian wheat really is limiting. On top of that, we're going to have a lot of protein in SA and Vic with the tighter seasons there. And huge crop in New South Wales. So there's going to be a lot of everything over there. So I mean, the upside for protein really is going to be quite capped by that fact, even despite the fact we may not have a lot here in WA. The higher screenings grades, it really is quite tricky as well. Last year, a lot of the higher screenings wheat we ended up going to feed markets. We really struggled to place that with milling homes. But a lot depends on the overall screenings level in the main milling grades. Last year, the amount we could blend away was pretty limited. If we have slightly lower screenings in the main milling grades, potentially you can blend away, and we can pay a high value for the higher screenings grades. Noodle wheat will be quite interesting. I mean, pricing is very sensitive to supply in the noodle wheat market. The demand is steady in Japan and Korea, not really changing. Obviously, the crop is swinging a lot year to year. Early harvest indicates, a pretty reasonable volume of noodle wheat in Kwinana zone. So just be aware that waiting to the end of harvest will not necessarily result in a much higher noodle wheat price. It will really depend on the supply, and we have to take it from there. Next slide. Just some bullish and bearish factors. I mean, in the near term, the cash markets globally really are looking under a lot of pressure. As I said, Black Sea continues to push wheat out. Argentina, Brazil is really pushing into Southeast Asia. So the cash market's under a lot of pressure at the moment. Australia is missing a lot of business into Southeast Asia. With the size of crop we have coming, 30 million tonnes plus, nationally, we shouldn't be letting this volume of South American wheat really come in and trade into Indonesia, but it is. I mean, ultimately, because growers have been holding back from sales, so it is what it is. But Australia is missing business that is not necessarily be replaced. But bullish factors, what are they? I mean, really the main one is the smaller Black Sea crop. And, in the first half of next year, we should see Russian values continue to edge higher, all else being equal. I mean, they just can't continue the same export program they've had. India imports, I mean, there's been whispers that India may need to come to the market, import a significant volume of wheat, yet to be confirmed, but the domestic price in India has been moving a lot higher. So that's quite interesting. We just have to watch that one closely. I mean, typically, they do love Australian wheat in India, but I mean, given the price spreads at the moment, they probably would more look at Black Sea. But I mean, if they did come to market, they would probably soak up a lot of Black Sea supply and support the market overall. Consumers are very hand to mouth. And why is that bullish? Well, I mean, if you think about the world as X amount of 12-month demand for milling wheat year on year, consumers 2 years ago were buying 4 or 5 months forward because of the bullish outlook on the market at the time, because of the massive China wheat import program, which was chewing up the stem. Over the last 2 years, they've been pulling their purchases back to the point now where they're basically buying just in time. And a lot of that's driven by the structure of the Russian market now. There's basically no forward market for real wheat suppliers in Russia. Basically, it's a spot market, and which has suited the consumers in a bearish market. But if things change, they will have to buy a lot of wheat very quickly, and that could push things around. But we need to see a bullish input for that to happen. Bearish, I mean, it's what we've talked about, the South American wheat, the Aussie balance sheet. We need to find export demand. The Chinese economy, so we don't expect a huge China import program this year. The Chinese economy has been in very, very poor shape. Now, recently you would have heard they've announced some stimulus measures. Maybe that can improve it, but I don't think it's necessarily going to flow into milling wheat demand. The Southeast Asian markets are extremely competitive. I mean, we're just being played off against the South American and Black Sea wheat every day. And a Russia-Ukraine peace deal, what could this mean? That's quite interesting. In the short term, it's probably a little bit bearish for Aussie wheat because the ocean freight premium for getting a vessel out of the Black Sea would fall, because at the moment there's a big insurance premium to take a vessel into the war zone. That would fall. But longer term, actually, I think it's probably a bit supportive, because I think the Russian FOB price should firm on the end of the war. Basically, there's been something of a discount for the Russian price to push it out, given there are still some consumers, some origins, some destinations, that won't take Russian wheat. If the war ended, the payment restrictions came off, the Russian FOB price should firm. In the very near term, if it happened, I think, the freight rate would fall immediately. But in the coming weeks and months, I think the FOB price would rally. So that could be a slightly bullish factor. What to watch for? I mean, currency, we don't know where it's going, but I mean, it's a big impact. I mean, there's no margin for the trade in buying wheat from the farmer and selling to Southeast Asia or anywhere else at the moment. So day to day, the Aussie US dollar rate is probably having a bigger impact on grower pricing than any other thing. Definitely the futures, which are probably less relevant at the moment. The Trump factor, I don't know what it means for Aussie, but I mean, obviously a weaker Aussie is good for the farmer and good for the grower bid. Will demand improve? I mean, it's pretty benign. We didn't talk about some of the other global demand factors. China's a big one. Over in the Middle East, I mean, Turkey, one of the biggest importers in the world, also stopped importing wheat the front half of the year. That was a massive negative impact on the world market. Will demand improve and come back? I mean, our Southeast Asian customers tell us that things are improving. It's definitely a better outlook than it was 12 months ago, where they were quite negative. So things have improved over the year. But I think the big one is China, really. So And the big one will be, look, February, March, April next year, what are new crop conditions in the Northern Hemisphere? The Russian crop is going in quite poor condition into the winter. The French are quite slow planting their crop, the winter wheat crop there. So there are a few things which could eventuate. In the US, conditions in the plains there were quite poor, but recently have had some big rains. So we'll wait and see. Historically, there's a pretty poor relationship between conditions at this time of year in the winter wheat, Northern Hemisphere, and final yields. It does really all come down to spring, but something to keep in mind that the Black Sea, Russia in particular, the new crop conditions are quite poor at this stage. So we'll keep an eye on that. So that's basically wheat. It's quite a benign market outlook, really. We don't have a big demand pool. We're struggling to find demand. Grower selling has been slow, but on the same other hand, the consumers don't see any reason to be bullish because they're just getting flooded with offers from Australia, Black Sea, South America, and they say no reason to panic at the moment. So that's the wheat market in a wrap. Yep.
Thank you, Will. Now we have Drew Robertson to provide a barley update. Thanks, Drew.
Good morning, everyone, and hope harvest is treating you well so far. First slide here, just looking at Australian barley exports for the 23-24 season. So last year we reached 7.9 million tonnes of exports, with nearly 6 million tonnes, or 78% of those, going to one market in China. I think, there was very strong front-ended export program last year, driven by strong demand from China and availability of carryover stocks to ship in early October, November. So I think there was a very large forward sales program for October, November, December, and January last year. I think contrastingly, this year, we don't have anywhere near the same size sale program on to China at this stage of the season, and I'll talk more about that on the next slide. Some of the go back, haven't finished yet. Some of the interesting points to call out here: very strong. Despite lower national production last year, the large export program effectively ate through the larger than normal ending stocks we've seen for Australian barley after the last 2 or 3 years. And that carry-out level is now back to more normal levels, around 1 million tonnes. A couple of other things: Mexico, Peru, and Ecuador remain part of our export destinations and were important markets for malting barley, despite the return of China last year. And I expect those markets to remain part of the export profile into 2025 as well, with some business already done into that region. As always, Japan was the second largest market, and I expect that'll remain the same this year, although we will come under competition from Canada into Japan through the early parts of 2025. Next slide, please. So one of the reasons why the forward sales book isn't as big as last year is because the China government has unofficially restricted feed grain imports for the remainder of 2024. So the chart on the left-hand side here shows barley imports into China from 1 October 2023 to 30 September 2024. That was 15.9 million tonnes, which is an all-time record for that market, the largest imports they've ever had. And that was on top of 23 million tonnes of corn that they imported over the same period. So due to these huge feed grain imports, the Chinese government moved to make that unofficial restriction on feed grain imports. And the reason for that was to protect domestic farmers and support demand and domestic prices for Chinese farmers as well. Harvest is nearly completed in China. It's coming to an end. But the forecast for their domestic production is, depending on who you believe, 292 million tonnes as per the USDA, or 300 million tonnes according to China's Ministry of Agricultural and Rural Affairs as well. So, big sort of program there to try and restrict imports of feed grains, that's barley, corn, and sorghum, and to protect that domestic market. The other thing that's been happening in China is tighter customs inspection on discharge, so slower issuing of import permits, tighter inspections on discharge, which has caused some issues for recent vessels. And on top of that, the GACC, the General Administration of Customs in China, issued nearly 300 non-compliance reports to Australian sorghum and barley exporters about 2 or 3 weeks ago. And that was issued to the Department of Agriculture in Australia and then communicated to industry. And so those non-compliance reports relate to the presence of weeds, seeds, and other items of phytosanitary concern for China in that market. So all of those measures that have been taken have really dramatically reduced demand and slowed sales into that market. So that's why we haven't got the forward sales position on the whole market, that is, that we would have seen in the previous year when the market had just reopened. And finally, on that one, there's a lot of uncertainty as to what's going to happen in 2025. The restrictions to the end of 2024, but really there remains a lot of uncertainty around what will happen going forward. Next slide, please. Having a look here, we've just got global barley supply and demand here. The major exporting countries, their production numbers are called out on the right-hand side there. And global production is pretty much locked in at this point. There might be some minor changes due to harvest ongoing in Australia and starting in Argentina. ABARES USDA are at 12.2 for Australia. Potentially that's a little bit on the high side, with some issues being experienced in South Australia and some in Victoria as well. Obviously, the New South Wales and Queensland crops are looking exceptional for wheat and barley as well. I think from a barley perspective, though, a lot of the exportable surplus out of Australia comes from Western Australia, South Australia, and Victoria. And both South Australia and Victoria aren't going to have the supply that they've seen in recent years. The stocks to use ratio in the bottom left-hand corner of this slide is at 11.98%, which is the lowest since probably the mid-80s, the lowest it's been since the mid-80s. However, the thing to watch is on the consumption or the demand side of the equation. So last year, global consumption was 141 million tonnes. This year, the USDA is forecasting close to 146 million tonnes, but at this point in time, I don't see anything to suggest that demand is going to be higher this year than it was last year. So demand remains weak, and the market really needs a demand story to achieve that consumption number. Without it, consumption could be easily 5 million tonnes lower, and that 5 million tonnes would essentially just get added directly to the ending stocks, which moves the balance sheet from a very tight position to more comfortable levels. The only other alternative on the S&D piece would be a serious production issue in the Northern Hemisphere in 2025. So that's one to watch out for. Next slide, please. So just to wrap up on barley here, so some of the factors influencing the market. So obviously that balance sheet is very tight, very low stocks to use ratio. Sorry, that should read 11.98 there. But we've got to watch that consumption number to see what happens. I think the other concern is that the price of feed barley compared to even South American feed wheat and corn prices is quite high. So we're really not turning on any alternative feed grain demand in Southeast Asia or Thailand to increase that demand level. So, at current price levels, feed barley demand will continue to be rationed, which is going to really impact that consumption number. We've got low selection rates in WA on malting barley, although they are improving as harvest progresses. And obviously, as I mentioned, the SA drought, and that's providing some support in barley markets, especially for nearby shipments. limited supplies remaining in the Black Sea for the first half of 2025. So Romania, Russia, they've all sort of executed a fair chunk of their exportable surplus this year. Don't expect them to be a major feature of the market in early 2025. The main competing origins are going to be Europe, Argentina, Canada, and Australia. Couple of bearish points is the feed grain import restrictions in China and what's going to happen there going forward. Argentina production is looking good at around 5 million tonnes. They've got about 3 million tonnes of exportable surplus, and Will was talking about how aggressive they're marketing wheat into Southeast Asia. They'll be looking for homes for that 3 million tonnes of exportable surplus as well, as they start harvest in the next 2 or 3 weeks. Globally, feed grain demand remains weak, and I said, we're really looking for a strong demand story in 2025 to kick things along. And Saudi volumes are in decline. They continue to wane. I think import forecasts there are just over 2 million tonnes now. They've already taken a sizable chunk of that from the Black Sea new crop over the last few months. So, that continues. That market in Saudi continues to be quite weak. Global beer consumption remains weak as well, and that's impacting malting barley demand. So when you look at the West Australian situation, you've got the tight or the low selection rates of malting barley and tighter supply of malting barley, but we're balancing that off against a globally weak beer consumption environment and weak malting barley demand as well. So despite the low selection rates, you're unlikely to see a significant rally in malting premiums. With regards to some of the other things just to keep an eye on, obviously geopolitical uncertainty reigns around the world at this point in time. Specifically for barley, Russia, Ukraine, Israel, Palestine, USA, China, Trump being elected, and some of the industrial action that we're seeing in Canada as well. And that's it for barley. Thanks.
Thanks, Drew. Now we have Jared Meredith, our protein and oilseed trading manager, to provide a canola update. Thank you, Jared.
Thanks, Jules, and good morning, everyone. We've got to start off the destinations for Australian canola exports from 23-24, which is probably more diverse than we're going to see certainly in 24-25, with markets there as far as Mexico. Pakistan's another one that's come up for non-GM more recently, and Bangladesh and the UAE as well. But I think what we could expect in 24-25 is a greater consolidation of Australian exports into the EU market. Canada, with the announcement in early September of the anti-dumping investigation that China launched into canola, has needed to find new markets and retain or win back market share, probably more accurately. The destinations like Mexico, Japan as well, where Australian exports have been strong in the last couple of years. I guess adding to the smaller diversity in Australia's expected export destinations, we've got a smaller production in 24-25, with significant decreases in Victoria and South Australian production, that should say, instead of New South Wales. So New South Wales production is relatively strong, or is strong, and we'll see tonnes flowing across the border into Victoria to be able to be loaded onto vessels and exported into international markets. But South Australia is really struggling this year with a very small crop as well. I think key point to make for us going forward is the competition that we are seeing from Canada at the moment. As a GM exporter, I think it's hugely reflected in our non-GM GM bids to the grower, and the opportunities for GM exports are being limited by Canada's increasing market share into markets that we've been shifting canola to in the past. Thanks, Jules. So the canola market's been quite dynamic in the last couple of weeks. When I did these slides or prepared for this last week, there was a really There was a supportive sentiment in the market, powered mainly and driven mainly by what was going on in the palm market, but also the bean oil market as well, where strong exports out of Indonesia and Malaysia was pushing the oilseed complex to new record highs, and bean oil was starting to turn as well, despite significant soybean production heading this year with strong production in South America as well. Canola's S&D was equally as tight, and that was lending support to higher prices as well. But we've been unstuck this week by the double announcement, one coming from the Indonesian market regarding their inclusion of palm oil in their biofuels, which was expected to go up to 50% in Q1 of next year, but now it's sort of been pulled back to the 40% that was initially slated, with going an extra 10% to be included from 2026 now. So there was talk about that on Monday, and in addition, incoming President Trump announced that he's going to unwind a number of clean fuel initiatives in the US in his first day in office, and also announced who the environment minister is going to be in the US, and that was seen as being very bearish for biofuel production in the US going forward, in favour of more crude oil, or continuing to drill for crude oil, essentially. What we've seen in the canola markets as a result of those announcements is that Canada in particular has been affected by that. Their domestic crushing industry will be impacted by changes in the US, but we've seen the EU market hold up relatively better compared to these other oilseed markets, which is a function, I think, of their relatively tight S&D, or tight S&D, I would say, for non-GM canola. Going forward as well, looking a little bit further forward, Ukrainian planting is lowered for 25-26, and conditions there haven't been favourable to date. So that could weigh on production estimates that would be available from July onwards, with Ukrainian seed coming into the market. That may give Australia more opportunities for non-GM and potentially GM as well into that EU space. I think it's worthwhile also noting that the EU marketing window is narrower than some of our other markets that we've got, just because of that new crop supply that is available in early July. And there, I expect a strong export program in the first 5 months of 2025, so that we can get vessels there prior to that new crop coming available in the EU and Black Sea. EU doesn't generally want a vessel after May. The reason being, it takes about 45 days for a vessel from WA to reach the EU market, and if it leaves West Australia much later than that, then they will be competing head to head with cheaper new crop supplies. On the bearish side, I think we're seeing multiple offers from Australian origin and Canadian origin into the EU market for GM meal. Australian GM meal and Canadian GM meal certainly flooded the EU market, and they're finding it difficult to find markets and homes for that meal that they're taking on. The feedback that we're getting is that biodiesel demand is strong in the EU space, but the meal is certainly weighing on their opportunity to take more GM seed at better values out of Australia and also Canada. We've spoken a bit about the anti-dumping investigation, and when we consider how many exports from Canada last year went to China, which is around 4.3 million tonnes, the need to find destinations to replace that sort of volume, albeit that there has been some exports into that market this year that was in the books prior to the announcement, but certainly Canada is looking to replace that export volume that has previously gone to China in other years. The other hurdle that canola has, which was, I think, weighing on the market prior to the more recent rally, which is perhaps more driven by palm, is the S&D for soybeans, which is very cumbersome and certainly reflective of the demand situation in China, which I think both Drew and Will have spoken about as well. I think that's affecting soybeans and production at the moment. There isn't many concerns, particularly in South America, going forward here. And then we add in the fact that perhaps there's potentially less crushing for biodiesel with new policy or unwinding of policy that's currently in place in the US, then that S&D could be a bit heavier going forward too. So we've talked about the changes in policy. Other things to watch is certainly the Canadian export pace, which has been at record levels up until this point of the year. There's been a huge push in Canada to get as many of the sales that they had in the books out to China as quickly as possible to avoid a potential tariff that hasn't yet come into play. China certainly had that demand and wanted to get as much stock into China as possible. And I think that's been executed well out of Canada and reflected in the export pace. If Canada's production, which is sort of flagged as being around 18 million tonnes now, if it dips below 18, then potentially it starts to tighten up in the back end of the year. But the changes in the US policy could change that situation a little bit more, and perhaps Canada's got more to export in the back end of the year where previously they may not have. Looking closer to home, WA's GM percentage continues to rise. So I think last year we were close to 60% GM deliveries into the CBH network, and that's risen significantly again this year. It seems like a trend that's certainly probably a challenge to reverse. I think when growers were making their planting decisions earlier this year, the spread was significantly lower. So perhaps it doesn't accelerate as it has been in the last couple of years for next year, but that'll need to be reflected. That indicator will need to be shown to the grower through the market and the non-GM GM spreads that they'll see for 25-26. Touching on China as well from an Australian perspective, so currently there's still no bulk export protocol in place that is required for the resumption of trade. Certainly a space that we're watching closely, and CBH is working with industry and helping with government where we can to try and assist in that space, but there's really no update to provide currently on that one. And longer term, there's obviously some talk and news around domestic crush opportunities in the Kwinana zone in particular, which I think would be beneficial to the rising GM percentage in Western Australia, and probably provide growers with more opportunities to grow additional volumes of canola as well, which I think would be a really positive thing and supportive of grower values here domestically. It would make the WA bids slightly less reflective of international values, and perhaps more of those domestic factors around our production and things like that could be factored into grower bid levels when these are up and going, or potentially up and going in time. Thanks, Jules. Quick one on lupins and oats as well. I think this year we haven't seen a significant increase in plantings from growers, just quite strong prices, and I sort of just empathise with growers in the fact that they feel like, particularly on oats, I would say more so that when they've swung into additional oats, perhaps the price and the market's moved away from them. I think the market is probably more mature than was certainly 5 years ago, and demand is increasing into China, and we're also seeing additional demand into the Indian market as well that's been serviced by exports from Western Australia too. And then I think additionally to that, there's the increases in demand from the domestic milling industry, who are all investing in their facilities to try and make them grow and make them provide themselves more opportunities to service the export markets internationally, and also some of the domestic demand as well. Our exports for oats and lupins will be focused on key markets. So for our lupins, that'll be into the EU and the South Korean market, and our oats mainly for China. And then we are seeing increased interest into the Indian market as well, as I touched on. Going forward, I think we acknowledge that there's some additional production risk associated with lupins and oats in particular. And where CBH is looking at different ways of contracting that will help growers address some of these production risks throughout the year and give them some opportunities and flexibility with the contracted quantities that they commit to early in the year that they may be able to wash out of. So I've given a little bit there, but it's probably too early for us to provide much more detail at this stage. But we're looking to try and get that information out there, certainly prior to seeding next year, so that growers have another option and have the opportunity to consider planting additional lupins and oats for 25-26. I think we've got markets for those commodities who would like to see more growth in terms of the plantings and opportunities to contract internationally. So I think we're trying to reflect that opportunity with our grower members. That's all I had, Jules.
Thanks, Jared. Now we have the new head of structured products, Michael.
Thanks, Jules. Good morning, everyone. Very glad to be here. We've got a few slides on the pools just to talk through, and I guess just firstly maybe to reiterate what's the value in the pools this year. Well, there's two main drivers that add value for the pools, and firstly, access to international markets, and secondly, to have CBH manage that grain throughout the season for the grower. Two charts here, actually. The one on the left is the oats pool that's just closed in October. And what this chart shows is the dark blue moving line. That is the cash average from all the marketers throughout the season. The dotted blue line would be the average of that line, and then the brown line would be the price achieved. So traditionally in the oats and lupins, I know markets change, but we've had a good run outperforming the markets here. So that one achieved a return of 559 versus the cash average of 501. The second one, the one on the right, that's still ongoing, but it's 100% sold. So we might improve on some of the costs, but this is the current harvest pool for the season just closing for lupins, and that's having a return there of 527 against 504. Next slide, please, Jules. So I guess just to reiterate what we do in the pools team, we basically sell our grain on a profile throughout the season. So the chart on the left, the dotted blue line is the target that we're measured against. So that will be the cash average. And there's two times a year to get in the pool. Obviously, the flexi pool, which you're aware of, is starting in July. And then we have got the harvest pool, which starts in October and will close at the end of January. So the pools team have some flexibility. So the top right line is the maximum percentage sold we can be for that pool. And the green line at the bottom will be the minimum that we need to sell to kind of keep up that profile. So we do have a degree of flexibility in managing that. That's both on the grain and on the currency as well. So things to mention this year, the flexi pool selling is well progressed. So they're the ones that started in July. The harvest pool, we're also selling is underway. We're working on forecast tons because we don't know the exact grade, quality, and tonnage we will get in for this season. So that's all forecasted. We've been actively managing the currency. So particularly over the US election, we've had some options in place that allow us to have some protection and then buy as we see the market fall here. We've been enhancing the returns with some derivatives hedging. I'll mention those on the next two slides. The physical sales have been international, and a thing to know is the shipping capacity actually. So when we had those two really good harvests, the pools would need to sell such a large amount that basically you would need to be on every sale where and not have the ability to time so much and take a view. But certainly with shipping capacity not an issue, we can be more selective in this environment on sales. We've achieved good spreads on malt barley, on noodles as well, and the canola sales we've made to date have been basis, so we can still benefit from this rally in prices, which we have done. On to the next slide, really just to talk the next two about the value proposition that we can give naturally. So we're selling on a profile, and if we look at this chart, what we see is the white line is the near or the December Matif wheat future. The blue line that trades above it is the March future. So we've got a natural advantage here, being in the pools, that we need to sell throughout the season. We can sell and hedge and protect our values in those months ahead. So we've got a natural carry advantage there, which is displayed in the option prices and the futures as well. We can look at the second advantage really here in this market is there's a bias or a risk reversal. So the calls trade at a premium for the puts. So if we want protection to the downside, it's cheaper. And in this Matif as well, we see these vols at pretty attractive levels. So to explain the other two lines, the green and the red, that's where we've been buying some options, giving us some protection and allowing quite a lot of upside participation. So what's that's allowed us to do, we've been looking at these 220, 230 puts, not paying a lot for them really, and on that rally, so they would be for the March expiry. On any of the rallies, we would sell the March future, so we could enable us to sell at 245 on the rally while still maintaining the protection, and then as it comes back to those levels, taking that protection, those sales off as well. Onto the next slide, Jules. We've got a similar story here on the CBOT. And what this chart is showing, again, the white line is the December contract, the near future, and the orange line is the May future. What we see a decent amount of carry, which is then reflected in the option prices here. So we've got the carry, we've got the risk reversal here. These vols are a little bit higher, so we can trade them via spreads. So we'd be buying the red strikes versus the yellow strikes, taking them off, which we'd be very happy if those upper levels trade and we're taken out, because that will be achieving good prices for our growers, whilst giving us some protection further out as those near-term physical sales come in. So apologies if I've confused anyone there. I know the derivatives is a bit different, but it does talk to some of the value proposition we offer as a team.
Thanks, Michael. Now our last presenter is Mandy Johnston, the head of Grower Service Center, to provide a DailyGrain update. Thanks, Mandy.
Good morning, everybody. Happy harvest. The second week of November is always typically what we call go time. So nice to have everybody able to make some time to chat with the M&T team and for us to be able to jump on. And just most of you have been already reached out to about what's happening in the DailyGrain and marketplace space, but just three main things that we've got on the go. Wayne is back on deck. He couldn't stay away. Semi-retirement was not really for him, and there's so much going on in our space that he needed to get back in and be a part of it. So make sure if you haven't reached out to Wayne, get on the blower to him. We've got our payment protection process, which is just going through regression testing and really close to being live now. So the changes to the product will offer added protections for sellers and buyers. And we also have a new look and feel, which will be released in the coming weeks with landing pages that are set up for specific user groups. So we'll have a grower seller landing page, a buyer landing page, and a consultant landing page. So looking forward to showing you those as they go into prod. And next slide, please, Jules. And then just a little summary to remind you of what our payment protection really goes into. So we've got security of payment. So payment is now secure and paid within 7 days or less. Transfer of title only proceeds after payment has been verified. So that's obviously always been a sticking point with Marketplace, and I guess with a lot of growers having to relinquish title before payment has been verified. So we're maintaining our low cost as well. So, you know, we obviously exist under the CBH banner to create and return value to growers. So we will be offering our premium grower members free trading on the spot trades. Standard members will be charged a total flat fee of $1 for secure spot trades. We have a new price protection element in the event that the buyer does not pay. DailyGrain will cover any mark-to-market loss for the grower. So obviously, it can be between kind of, you know, 5 to 7 days that grain is sitting in limbo. And we just want to make sure that if there's a significant market move, particularly with all of the geopolitical events which are coming up, we just want to make sure that growers are further protected, and just reminding you of the integration that we've got Marketplace fully integrated with LoadNet, minimise the risk of overselling. So Wayne should have reached out to a lot of you. The call out here is just get in touch, ask us questions. Lots going on, looking forward to sharing it with you all, but I'm also aware that I'm standing in between you and the M&T Brains Trust for questions. So thanks, Jules. Thanks for the opportunity to chat, and good luck.
Thanks, Mandy. If anyone has any questions, just type in the chat and we'll address them now. I'll just give you a couple of minutes if anyone's typing. I can see someone with the hands up. You should be allowed to ask your question. Just unmute yourself. Okay, our first question is for Drew. What do you expect the malting premium to do over the next 3 months?
It really depends on that demand story that I was talking about. Unless we see a significant uptick in demand, then I think the malt premium is going to remain pretty subdued. We're trying to balance off the lower supply in WA, but against global, weak demand globally for malting barley and continued struggles in beer consumption. The other thing to keep in mind is that quality and selection rates in New South Wales look very, very good, so they could be a presence in the market this year as well.
Thanks, Drew. The next question is for Jared. Given the increase in GM plantings in WA, what are your views on GM, non-GM spreads for 25-26?
I think our spreads are certainly at the moment reflective of the market opportunities that we've got and the additional competition from Canadian seed going into those markets as well. So it's isolating our opportunities, the majority of them, into the EU space. I think, if that remained Australia's main opportunity to export GM seed into the EU, then I would expect them to remain very wide. But if there are new markets or Canada's production potentially is lower, or we see some sort of reversal on the anti-dumping investigation that is currently in place, then I would expect the spreads to contract more and the GM to sort of be closer to where the non-GM's pricing. So I think plantings are certainly going to contribute somewhat, but it's probably more of a factor of the market opportunities that we've got that's driving the spread at the moment.
Thanks, Jared. Another question for you. Oat demand for next year. Any idea on this? Some growers tend to grow next year as oat prices have gone down in the past following strong prices.
I think, I said we've got 3 domestic mills here in WA now, as well as strong opportunities into Chinese and Southeast Asian markets for our product. And I think where Australia's got some advantage on the oat side is that it is preferred from a sensory perspective and from a colour perspective to other origins as well. So we've got some captive demand there in the China market that is continuing to grow. I don't have a figure on what that total demand would look like. It's certainly price dependent, and Australian oats are losing opportunities to other origins at the moment. We're speaking to our Chinese customers who are importing Russian oats for products that are more processed. So things like muesli bars where the oats ground up more finely, they can use other origins, but for your granolas, your rolled oats that may be used in breakfast foods and things like that, the preference is to use Australian oats. So there is additional demand out there at the right price points, but I think we're consistently seeing that the carry out for Western Australia is very low in both oats and lupins, when we've got good enough market opportunities that's going to hopefully, I think, support additional plantings going forward here. And I think there's been some good work done in this space. I thought Oatspo was a really good event a couple of months ago now, and raising the opportunities that are out there for WA growers planting oats.
Thanks, Jared. I see that Selena has her hands up. If you unmute yourself, you should be able to ask a question. In the meantime, we got another question. Will, what wheat carrying levels do you expect into 25-26, and specifically what grades?
Good question. I think it's a bit early to answer that realistically. I mean, we don't know the crop size really at the end of the day. There is demand out there, but it's very hand to mouth. It's very competitive. I mean, I think we'll have a normal type WA carry out of, sub 1 million tonnes, assuming the grower comes to the table and sells their wheat. But I mean, look, if the growers just want to hang on to it, we keep missing demand. I mean, it could grow quite significantly. Today, I mean, we're probably most connecting on ASW9 and AWW type sales. We've been a little bit cautious on protein. So maybe if there's more protein out there, we'd end up carrying a little bit of that. But at the end of the day, there's demand for all levels of protein in different grades. It's just a question of where production is, I think, at the moment. There's a lot of shipping capacity out there. So the shipping capacity is there to move the crop. It's just a question of do farmers want to sell it, and how competitive is Western Australian wheat in our markets.
Thanks, Will. Any other questions? I'll just wait a few more minutes. If no further questions, I think we can wrap up today. Thanks again for everybody who joined us today. If you want to have access to the recording, or if you have any further questions, just email the Consults team. And thanks again, and I hope everybody have a good and safe harvest. Thanks all. Bye.